Stop it lah. I already have. She says you can see my wrinkles. I got a lot of wrinkles here. Here also. Here. Wrinkles are part and parcel of growing up, guys. But when you look at the baby's face, right? Zero wrinkles. Right? You look at Ethan's face. It's like smooth skin. I still remember that song. Smooth like a newborn.
Smooth like a newborn.
Really, baby skin is like extremely smooth. What happened then when we age?
We were there once, you know.
You were there? Alright, welcome back to Nuggets on the Go. Today we're talking about a very hot topic at this point of recording, which is interest rates. Interest rates has been the top of the concern of a lot of property owners as well as property buyers for the entire 2022 until right now. At the point of recording is May 2022. So interest rates, just have a look at all these articles. Even just today, there was an article that just popped up this morning talking about home buyers or homeowners who have existing properties might be in a double whammy when interest rates continue to rise or are expected to rise for another 4 to 5 rounds, depending on how many rounds the Federal Reserve is going to raise the rate hikes for the rest of 2022. So, of course, at the point of filming, we have already been through one of the largest increase, which is 0.5 basis points. So, that has technically tanked the stock market last week. Not only that, previously, towards the tail of 2021, cryptocurrency market has already has a lot of volatility, tech stocks, all the FANG stocks, a lot of volatility. And just as of last week, it responded to the rise in the rate hike through the stock market. And we want to discuss this topic in detail on how interest rates hikes could potentially cause any form of concern in the Singapore's real estate market. So let's dive in. So let's have a look at this chart first. We're going to showcase a lot of different charts and to explore the topic on what is the weightage of interest rate on the performance of property price indexes in Singapore, on the mindset of homeowners and sellers in Singapore as well when it comes to making decisions to purchase property, or should we time the market? So we're going to answer based on what had happened in the past, looking at facts, figures and charts, and then what people are thinking on the ground. And then the third thing before we end off is that what should we do? Should we time the market, or should we not time the market, or should we enter the market? So let's have a look at the first thing. The first thing is that if we take out this very fantastic research from Morgan Stanley, and this was released in the year 2018. So out of the 5 rounds of interest rate hikes in the past in Singapore's history, 4 rounds we have seen an increase in our real estate price index. Only one round, which was in 1996, 1997 during the Asian financial crisis, and back then there wasn't any cooling measures in the past. That was the only round that property price index dropped in tandem with the rise in interest rate. The rest of the rounds, basically, prices increased. And of course, if you look at that particular chart, there was this bar then talking about 2014 till date. So at the point of the research, it was released in 2018. So they are talking about that part, 2014 and 2018. But if I were to bring out this new chart, which is a new chart done by our PLB Insights, it showcased the fact that in the season of 2016 to about the tail end of 2019, we actually went through another round of federal rate hike increase. If you see that increase in conjunction with our property price index, it is the same thing that has happened as well, that our property price index actually went up when rates increase. So that in combination, we can summarize that out of 6 rounds of interest rate increment, 5 rounds we see an uptick in terms of property price index. What is going to happen this time round in the year of 2022? Rates are increasing. Will property price rise or will property price fall? So this is something that everybody is trying to answer. And why are we trying to figure this out is because this will cause a correlation on how we make decisions on whether should we wait for 2023, having a wait and see approach before we enter into the market. But we are going to dive in deeper because it will then help us to make sense of this current market, because waiting can be a very costly opportunity cost sometimes. Waiting can also be very beneficial because if you can buy something at a lower price, that will make a lot of sense at the end of the day. So Second chart that we want to showcase right now basically is to look at all the host of factors. If you have been following us, these factors are extremely important because there's in totality about 15 to 16 different internal and external factors combined, and all these factors will help us to make a decision on whether should we time the market. Now, if you look at the top, interest rate falls on, of course, one of the key factors together with quantitative easing. As of this year, we know for sure that interest rates are definitely going to increase. We also know for sure that quantitative easing is tightening. So when these two factors are gone, and these two factors are now one of the key things that might affect the property market, what is going to happen to the global property prices and what is going to happen to the Singapore real estate prices. So let's bring out this new chart now. Let's discuss globally, how do people view interest rates in terms of relationship to property prices. When we talk about interest rates rising, the next effect is that we will then discover and we'll try to ascertain, will an interest rate rise cause our disposable income to drop? And in reality, that is for sure, because when interest rates rise, just have a look at these two different examples. If we were to purchase a $2 million property when interest rate is at, let's say, 1.5%, if you were to purchase a $2 million property when interest rate is at 2.5%, just by a 1% increment in your mortgage interest rate, the installment amount in totality increases pretty substantially. And if you were to break down both installment components into the P&I component, principal plus interest, you will see a significant increase in the interest that you have to pay, which forms a huge portion of your total monthly installment compared to when interest rate was much lower at 1.5%. So 1% increment causes not just the total installment to rise, but it affects the amount of components that the P&I takes on overall in terms of the total installment. So there are two effects that happen just by a 1% increment. Firstly, overall monthly installment increase. Secondly, it becomes not so worth it in a sense that because the amount of principal that you're putting into your home reduces, and actually the interest that you're paying to the bank increases compared to when interest rate were much lower, you're actually saving more because you're putting more into a principal amount and you're actually paying much lesser interest to the bank on a month-to-month basis. So naturally, it's more advantageous for the homeowner to buy when interest rates are low compared to when interest rates are high. And globally speaking, correct behavior is that when interest rate increases, because of the fact that your monthly installment and monthly commitment increases, your disposable income as a family or as a home buyer drops. And when that happens, the amount of purchasing power gets affected. Overall demand will then start to dip. And when that happens as well, homeowners becomes more realistic as home sellers when they want to exit the market, when they want to sell their property, they will then price their property more realistically. So when this entire chain happens, property prices becomes more tepid, or they stabilize, or they start to fall, and depending on what kind of economy or what kind of country is this real estate market in. So that is the standard behavior when interest rates rise. On the flip side, let's run this chart. When interest rates fall, the reverse is going to happen. Firstly, when interest rate falls, it increases the purchasing power of home buyers because home buyers now become more confident. They see that borrowing cost has dipped, monthly installment is going to drop for the same amount of purchase price of a particular property. Everybody becomes more confident because I'm paying lesser for my interest. Overall monthly installment drop. Some of my rental can cover the entire cost. I feel more confident as a home buyer. And because of that, demand surges in the entire economy. And that then brings about a rise in prices because when demand increases, homeowners then know that the demand is out there right now. They want to raise their price and challenge the selling price before they are willing to let go of their property in the secondary market. So when that happens, interest rate fall correspond with a rise in prices. So let's have a look at the third scenario, which is the base case, and based on historical data, out of 6 rounds of interest rate rise, why is it that Singapore home prices still rise, and why is it that it behaves differently from the norm based on the first 2 scenarios that we're seeing? Will this round have the same effect as in the past? Because what we're trying to answer is that this time round, interest rate is going to rise. Will our price go up, stay stagnant, or will it come down? Secondly is that we also want to answer this question because maybe you might be asking, hey Melvin, why are we in Singapore in such a way that when interest rates drop, prices rise? Why is it also that when interest rates rise, prices still rise? And then what should I do as a Singaporean, or what should I do as an investor in Singapore? Should I buy? Does it mean that we buy all the time? Does it mean that it is wrong to time the market? Does it mean that whether is it in the year 2020, 2021, 2022, 2023, 2024, I should always buy? And we're going to answer all this fantastic question. And these are very legitimate concerns because we want to understand when should we enter the market, when should we not. So let me just clear this out of the picture first. Firstly, when we bring back this chart with about 15 to 16 factors, we can see that interest rate and quantitative easing correlates to the amount of liquidity that flows into money supply, the expansion of money supply in the entire world, in Singapore, in US, and how is that important? And that definitely has to do with inflation. Because when our money supply increases too fast over the past years, because the central banks are trying to save the market by buying out government bonds, increasing the amount of money supply, that has caused and created a huge amount of liquidity in the market. And when that expansion happens, we can see that in the stock market. We can see the flight to safety when people profit take and they want to park their funds in assets with a better store of value, and a more stable store of value. And when inflation rises, asset inflation also happens at a rapid rate. So back to the topic, CPI inflation happens right now in Singapore. In March 2022 is at about 5.4%. Asset inflation behaves extremely differently. So we're working on this brand new chart to ascertain CPI inflation in relation to asset inflation on landed properties. So although we are looking at CPI inflation of about 5% in the past month, the actual fact is that in the past 2 years, asset inflation on particular regions of landed properties, and this particular type of landed property, just for example and showcase inter-terraces, it has already appreciated by 20 to 33%. So on the ground, assets behave drastically differently, and compared to CPI inflation, it is not a good gauge of property price inflation growth. So when we take that into consideration and looking back at this entire list of factors, interest rate is just one out of the 16 factors that we need to consider on what grounds real estate in Singapore. Because the very reason why Singapore might possibly behave differently could be so many different factors. Number one, let me bring out this black color chart with like a stacking model. So this stacking model shows the foundation of Singapore, because the base layer of most properties that Singaporeans own, having 75% of Singaporeans owning HDB apartments, forms an entire suite of foundation in terms of our real estate market. Reason being, 90% of Singaporeans own their own property. And most of Singaporeans own their first property as a primary residence property. And meaning that a lot of people own properties to stay for family building, buying properties near to their kids' schools. And there's a lot of reason that people hold on to their property without speculative reason. So meaning that if I were to buy this property here, maybe it's because it's near my parents' home or it's near to my kids' school, the likelihood of me trying to quickly disposing the property that I'm living in through an economic downturn is very low, because I have a very strong propensity to hold on to my property, because my motivation is not for speculation reason, it is really for my family's needs. Thus, with the bedrock of 90% home ownership, that creates an enormous moat in the Singapore real estate market. And then as families with dual income do well professionally, they then upgrade to the OCR condos, or they upgrade to RCR and CCR condos, and then they might also upgrade to the landed property market, which is about 5% segment in Singapore. So that creates the entire foundation. Second chart that we bring out right now, cooling measures. Of course, right now, if you look at all these bar charts that our PLB Nucleus team, which is our PLB tech team, has created, there are close to about 20 different types of cooling measures already into the price graph. And we're still seeing Q1 2022 having an uptick, not just in the luxury market, but also in all regions of the market. With that creates also another solid foundation, because seller stamp duty is one major deterrent that people will quickly offload their properties. Everybody is buying into their real estate, if let's say it's their first property, with a desire to live in it or a desire to own it for at least 3 years. So that seller stamp duty technically increases the holding period of homeowners. In fact, there's also this chart that ever since seller stamp duty was introduced, the holding period of every singular property that people buy in Singapore has increased to an average of 7 to 9 years. Secondly, on top of seller stamp duty, everybody now purchases property with at least a 25% down payment. And on top of that, we still have to pay a 4% buyer stamp duty, and that's 29% down into the property. So people are entering real estate with a capability to come with at least 29% as a first tranche of down payment that is needed, which is 25 plus 4. The third effect is that everybody is buying in with financial prudency because the TDSR scrutinizes everybody's income, credit, debt to ensure that you have a base case of at least the ability to service the loan up to a 3.5% threshold interest rate. And that's the bedrock of TDSR calculation from MAS. So that then increases a homeowner's confidence level in holding their property for at least the midterm, or I would say for at least 3 years. And thus, if, let's say, from 2022 to 2025, if there were to be any form of economic downturn or recession, every single owner, because of the fact that they have these three things as foundation, seller stamp duty, 25% plus 4% down payment, TDSR calculation, this creates a confidence that they might not need to fire sale their property, because anyway, this is buying for own stay, it's buying really for my kids' education, it's really buying for my family to enjoy the property. And the icing of the cake is that everybody has this thing called the disposition effect, which means that if, for example, somebody were to purchase, example, a new launch property back in 2020, and let's say having all this thing in conjunction with the disposition effect, is that if their property is not performing, for example, let's say they bought into this new launch at $1,600 per square foot, and it's not performing, meaning that even after TOP, the price is not rising because of maybe any form of recessional risk or maybe economic downturn, what is technically going to happen through the mind of the home buyer that has bought this property in the year 2020, and in 2023, they collect their keys, they bought at $1,600 per square foot. 2023, let's say, when the property TOP'd and they want to exit the market, and it's still ongoing at $1,600 per square foot because nobody is able to exit at, let's say, $1,800 per square foot because the market is not doing well. What is going to happen is that the first thing that will go through the homeowner's mind through the disposition effect is that they will not sell. They will move in, or they will rent out, or they will wait for the market to recover. The reason is because they are already in the game. They have skin in the game. There's no point in selling back at the same price because that will mean that they will be making a loss through the holding cost, through the bank interest rate they'll be paying, through the buyer stamp duty that they're paying. There's no point in them realizing the loss. It's similar to somebody that has bought a stock or that has bought this particular counter in the stock market, and now because of the market downturn, they are seeing red on their balance sheet. And what is going to happen is that they will not exit because they don't want to realize their loss. It is also called the loss aversion theory. So they will only exit to profit keep if the market rises and they want to cash in on their profit. So there is a similar effect as well in the real estate market. And because of this position effect, what we're going to see is that if owners don't make that paper gain that they're looking for, they might just hold on to their property. And that also reduces the speculative effect in the Singapore's real estate market. And because of that entire mindset and entire thing, we think that what is going to potentially happen in the next 12 to 18 months is that even if interest rates were to rise, a lot of people are already in the market and they will not easily throw off their properties unless they own multiple properties, and unless their multiple properties also have that secondary factor is that, for example, if they have a second property that is, let's say, a 1 or 2 bedder in the CCR region or RCR region, unless they are unable to find a tenant or to rent it out effectively to at least cover most of the mortgage, then that will cause an issue. Or maybe they have 2 to 3 properties, they are unable to find tenants to actually occupy it, and there's a lot of high vacancy risk, then probably they might feel stressed from the monthly mortgage payment. But let us look back again on how did these homeowners initially own 2 to 3 residential properties. Now, if you were to purchase any multiple properties in the recent years, what is technically going to happen is that if you are buying a second property through a decoupling module and you have, let's say, the hubby owning the primary property, Mrs. owning the second property, similarly, you also have to pay 20-25% down payment. What is going to happen is that you go through the TDSR process, you go through the SSD process, and if you are renting it out, if you can effectively cover most of the mortgage or you can cover the entire mortgage, then technically speaking, I think you are pretty well buffered. And on top of the fact is that if 2 separate owners after decoupling and owning 1 property each, and they are both salaried professionals having CPF contribution into your ordinary account every month, what is going to happen in that investment property is that, for example, if this mortgage is $4,000 a month and they have 1260 coming into their OA, that 1260 will definitely be going into paying off the mortgage. And you have then that $2,800 that you have to take care of. If your rental, if it's a $4,000 monthly installment, your rental is, let's say, for example, $3,500. That $3,500, after netting off that $2,800 you have to cover, will still give you a $700 cash excess. And you can use that $700 to pay off the MCSD fee of $300. You can still keep a $400. And thus, that is the mindset of owners that are owning two properties, husband and wife, kind of modular basis. Let's look at maybe another profile. Let's say, for example, singular investor already has their own property. Let's say he or she bite the bullet to buy a second property during maybe 2020 or 2021. In order to buy a second property, firstly, you have to bite the bullet to pay ABSD, which back then was 12%. And you bite the bullet to pay 12% on top of the buyer stamp duty of 3-4%. You already sunk in 15% to pay the additional buyer stamp duty and buyer stamp duty. On top of that, you can only loan 45% from the bank, which means you have to come up with 55% down payment. And because of the fact that you come up with 55% down payment, your monthly installment is going to be so little because you are only leveraging 45% on the bank. And because of that, that enhances the safety net, and there's no reason for this investor holding their second property to fire sale their property because they only have such a little mortgage to pay. And let's have a look at the key difference. If it's a $1.2 million property, 75% loan will mean that your monthly installment is this amount. $1.2 million property, 45% loan will mean that your monthly installment is only this amount. And if you already had the ability to pay 55% down, 12% additional buyer stamp duty, 3%, you already had 55 plus 12 plus 3, and that formulates a total of 70%. If you're somebody that has 70% to pay a $1.2 million purchase as a second property investment, I don't think the installment is going to be an issue for you. So with that scenario, I don't think this singular investor is going to fire sale a property in the event if interest rate were to increase, because that would not have a significant impact on the monthly installment. And if I were to take this singular investor second property to highlight here, having that 45% out of the $1.2 million loan based on, let's say, 1.5% interest rate vis-a-vis 2.5% interest rate, the installment increments is only so insignificant, and that is just a marginal increase, which definitely this investor with a 70% down payment ability can definitely easily take care of by just renting out this property very easily. With that, let's come back to that scenario again. So this time round, when interest rate increase further, what is going to happen to our real estate prices? I think that we have to really consider the third aspect that we kick off at the start of this video, is that if you are timing the market, let me bring out these 9 scenarios for you. So back here at PLB, we just did this through one of our sessions with our guys because we run this module called 777 series where we talk about investment concepts, property investment concepts deeply with our guys, and we study that week after week in order to grow ourselves together. So we come up with these 9 different scenarios. For example, somebody that's planning to buy a $1 million property. What is going to be the opportunity cost and outcome if we wait or we enter the market? So we come up with this permutation. $1 million property based on a 1.5% interest rate, and we project an outcome of 2.5% interest rate towards 2023. So based on $1 million property, if price were to stay the same, and the reason for doing this projection is that we want to see, should we buy now or should we wait until 2023 when interest rate increase to try and gamble and see if the price will come down? And if we do this projection out of the 9 scenarios, price remains the same, price dropped by 5%, price dropped by 10%, price dropped by 15%, price dropped by 20%, and following which price increased by 5, 10, 15, 20. These 9 scenarios, what is the probability? Now, based on this 9 scenario, we're going to write down all the break-even prices on the right-hand side for you to have a look. Meaning that compared to buying now at $1 million at 1.5% interest rate, vis-a-vis the 9 scenarios later, what will be our risk and opportunity cost? So, if you want to have a look at this, the only winning case is only if the price drops significantly by at least 15 to 20% for me to see a savings. And when we calculate the break-even price, we calculate based on the entry price of 1 million plus buyer stamp duty based on the purchase price of the 9 different scenarios, based on the interest rate cost holding for the next 25 years. And what this gives us is that we want to see what is the break-even cost of the different scenarios based on the entry price and the entry interest rate that we're entering to in 2023. And the only way for us to win is that we have to gamble and bet on the fact that price is going to collapse by at least 15 to 20%. Because other than that, all other scenarios basically is unfavorable to wait. Meaning that if we were to just take a gamble for the next 1 year and we wait anything that would be happening in this 66 to 70% range, it will be more unfavorable compared to me entering the market right now. So based on that, why do we want to take a gamble? And that's something for us to think about, because if we are to just bank on this probability of about 30%, what will be the risks that will be involved and what will be the opportunity cost to you as well? One more thing to take note of is that, then what about this 1 year? Where are you at? Are you maybe bunking in with your parents? Or are you renting a place and paying rental for your landlord? Or are you, let's say, delaying entering the market by holding on to your property? And of course, if you follow us, we also mentioned a lot of times that if you are moving to a bigger property, it's better to move to a bigger property first compared to staying put at your own property while monitoring the market, because bigger properties move much faster than smaller properties. So based on that, the three things, just to recap, we look at facts, figures, and charts. Second thing, we talk about the mindset, disposition effect, loss aversion effect of homeowners, home buyers. Thirdly, based on these 9 different permutations, and of course your own preference in terms of time preference, in terms of family preferences, in terms of investment preference, should you wait or should you not wait? So we hope that this episode on interest rates helps you, adds value to you. And once again, my name is Melvin Lim. Thank you for staying on Nuggets on the Go. We hope to see you soon on the next episode. Take care. And topping and what does that mean is that it's dropping with the disposition effect.